Hey everyone, in today's video, we're going to be talking about a topic that we receive a lot of questions around, and that topic is Roth conversions in relation to Medicare premium increases. So for those that don't know, throughout your retirement, if your income is too high, you may be subject to Medicare premium increases at various points throughout your retirement. And so in this video, we're going to be talking about, as you're implementing a Roth conversion strategy, wherever you are in retirement, does it make sense to perform a Roth conversion that's large enough that it might push you into some of these Medicare penalty zones? Does it make sense to take that penalty and perform that Roth conversion in order to avoid larger tax hurdles down the road? So we're going to be tackling this from a few different angles today. Again, this is a question that we receive a lot as people are implementing these Roth conversion strategies. Now, before getting into this video, if this is your first time on our Safeguard Wealth Management YouTube channel, or maybe you've watched a few of our videos already, and you're interested in getting more out of the retirement assets that you have already saved up, or you're interested in building a more efficient retirement income plan, this is exactly what we post videos on each and every week. So hit the subscribe button down below, click the notification bell, and you'll be notified of all future videos that we release. Okay, so let's get into it. Let's talk through, does it make sense to perform a Roth conversion if it pushes you into these Medicare premium increase zones? Okay, and we'll talk about what IRMA is and where these Medicare premium increase zones lie. But this is a very common picture that we see when we're building some of our forward-looking tax plans. This is a forward-looking tax graph. As you can see here, this person has a lot of different taxable hurdles that they're going to want to avoid, tax hurdles that they're going to want to avoid later in retirement especially. These green bars here are RMDs, and as you can see, these RMDs are going to wreak some real tax havoc on their situation. It's going to push them up into higher tax brackets, as we can see here. It's going to subject them to different tax hurdles like the capital gains bump zone. It's going to subject them to the Social Security tax torpedo. And so there's all of these reasons that we're going to want to perform Roth conversions early in retirement while taxes are low. As we can just see here, the zones that we would want to convert inside would be something over here, again, earlier in retirement. Now, we often get questions. This person is going to want to be converting is going to want to be implementing some pretty large Roth conversions through these years here. Now, what if they convert enough, or should they convert so much that it pushes them into these Medicare penalty zones? Okay, so for those that don't know what I'm talking about in relation to IRMA, in relation to these Medicare increase zones, there's something called IRMA. It stands for Income-Related Monthly Adjustment Amount, that if your income is too high throughout retirement, you may see premium increases. So these are premium increases due to high income. I have quotations around that because, as we know, high income is relative to changes and is relative to your situation. Okay, everybody views high income as a different number in their mind. There are 5 different premium increase zones. We'll talk about where these premium increase zones lie and what is the corresponding tax penalty for being inside one of these increase zones. And this applies to both Part B as well as Part D premiums. Okay, there are a lot of confusing things around IRMA, things that I see confuse financial advisors as well as retirees. Okay, first off, this income limit is based off what's something called modified adjusted gross income, not your taxable income. So this can be often confusing because there's different modified adjusted gross income targets in the tax code. We'll talk about what's all included in this modified adjusted gross income here in a second. The other thing to note, though, is this penalty is based on a 2-year look back. So the premiums that you pay in 2022 will be based on your modified adjusted gross income in 2020. So if you're performing a Roth conversion strategy at 63, that will affect your premium, your Medicare premiums at age 65. Okay? So let's talk about this confusing income target, and let's use an example. We have a married couple. They're both age 60. Now their adjusted gross income, so basically their gross income before the standard deduction, is $96,500. And they have $3,000 of muni bond interest. Okay, so to find their taxable income, the number that we would actually plug in and determine how much they owe in taxes, it's pretty simple. We would take their adjusted gross income, assuming they're using the standard deduction. We would just take out the standard deduction. So their taxable income would be $71,400. Pretty simple. We would take their adjusted gross income and we'd subtract out the married filing jointly standard deduction here. Okay, now modified adjusted gross income is a completely different income target. And again, this is what your premiums are based off for Medicare. Basically, you take your adjusted gross income, so that would be your income prior to the standard deduction, and you actually add in tax-exempt interest. So we would actually add back in this $3,000 of muni bond interest, and we would receive a modified adjusted gross income of $99,500. So just to step back a second, a lot of people think when they're invested in muni bonds that muni bond interest, the return they're earning on those muni bonds, are totally tax exempt, and that's not the case. They're actually federally income tax exempt, but they're added back into a few different tax planning hurdles or targets. They're added back in to determine how much of your Social Security benefit is taxable. Okay, they may be state taxable depending on what kind of muni bond you're investing in. And then obviously they're added back into this Medicare premium target here. So again, your modified adjusted gross income will be higher than your taxable income all of the time. Okay, see here that in this person's situation, it's almost $28,000 higher. Okay, again, because we have to add back in the standard deduction and we have to add back in muni bond interest. Okay, and so in 2021, where are these IRMA targets? Okay, where are each of these penalty zones? As you can see here, there are 5 different penalty zones. We have the single filers tax, or I should say IRMA zones right here, and then we have the married filing jointly IRMA zones right here. So for a single filer, if they have a modified adjusted gross income over $88,000, they will see their first premium increases. For married filers, if it's over $176,000, again, they will see their premium increase, Medicare premium increases. The first added expense, the first penalty zone here, adds in 2021, adds $860.40. Okay, why? Because they're going to see a Part B premium increase and they're going to see a Part D premium increase as well. So $860.40. That would be just one of those. They would just have $860 if you're a single filer. If you're married filing jointly, however, and you are both on Medicare, you can basically multiply this by 2 because you're going to have 2 premium increases here. And as you can see, as you go down the line here, you can see the various other hurdles, the other penalty zones here. Okay, and just so you know, when I'm calculating out 2,163, this is based off of the added expense from the base cost here. So we wouldn't add back in this $860 plus $2,163. This is already adding in that $860 increase. Okay, so again, you wouldn't add these all together if you're subject to this last zone here. It would just be this $5,202 expense. And again, if you're married, obviously multiply that by 2. And so as you can see, there are 5 different zones here that we need to be cognizant of, that we potentially want to avoid or potentially want to still convert into these zones here. So again, this is primarily what we're talking about in this presentation today. If you're going to perform a Roth conversion, okay, and these Roth conversions are large enough that they will push you into these different penalty zones, does it make sense to still perform that large Roth conversion? Now, granted, just so you know, we can perform smaller Roth conversions, okay? If we don't think it makes sense to take that extra penalty, just perform a smaller Roth conversion. But again, for those that are really trying to deal with some problems down the road that are going to be created by things like RMDs, and they have a small window of opportunity to perform Roth conversions, does it make sense to perform Roth conversions into these zones? Okay, that's what we're talking about today. Well, it's important to note, as we're talking about IRMA, that IRMA is a tax cliff. Okay, so there's a lot of different things within the tax code that are marginally increasing tax liability. So for instance, let's say you make $1 extra and it pushes you into the 22% bracket. Well, the federal income tax brackets are marginally increasing. So the first amount of money that you earn is not subject to tax at all if it's under the standard deduction. Then you're subject to the 10% bracket, then the 12% bracket. Just that extra dollar that you earned that pushed you into the 22% bracket would be subject to 22% tax. It's not as if all of your income is subject to that 22% tax. Well, IRMA works in a different way, just like a lot of healthcare costs work, where it's a cliff, meaning that as soon as you earn one more dollar, you are subject to the full premium increase. So in this example here, let's say that let's say your modified adjusted gross income is $88,001. Even though you just earned your modified adjusted gross income was just $1 more, it doesn't matter. You are fully subject to this $860 added premium cost. And so here's an important thing to think about as you're determining whether I should convert into these different IRMAA zones. The last thing that you want to do is convert just enough that you're subject to this next zone here. Instead, if you're going to be subject to a premium increase, you want to make sure that you're converting enough that you can convert as much as possible within this penalty zone. Because again, either way, it's going to cost you that full Medicare penalty. So the last thing you want is just to earn an extra dollar and be subject to it. You'd rather convert that full amount. And then again, that added cost for premium, that added premium cost will be lower relative to the essentially the extra income that you converted in order to be subject to that cost, if that makes sense. Okay, so again, we receive a lot of questions around, does it make sense to perform a conversion if I'm going to be subject to these Medicare increases? And this is going to vary widely based on your situation. Okay, I can't give a broad answer that applies to everybody. What I would urge you all to do, however, is take the premium cost, the extra premium cost that you would have, and simply add it in as your tax rate. Okay. Now again, there's going to be some different zones. If you're performing let's say your modified adjusted gross income is $50,000. Okay, and you're performing let's say a $60,000 Roth conversion. Okay, there's going to be two zones that you want to separate and calculate out your marginal rate. You're going to want to calculate out your marginal rate before you're subject to the Medicare premium penalty and then after the Medicare premium penalty. Okay, what do I mean by that? Well, basically, if we take the amount of income, the amount of income room in each of these zones. So this zone here, from $88,001 to $11,000, there's about $23,000 within this zone. And remember, we're going to have an $860 added charge. Well, $860 is divided by the amount of room in this zone, means that there's a 3.74% tax increase if you're subject to this zone. So for instance, if we're going to perform a Roth conversion and we're going to fully subject ourselves to this entire zone here, it's going to add 3.74% of extra tax within this zone. Well, again, assess this in relation to what your future tax liability is going to be. If you're performing a Roth conversion in order to avoid the Social Security tax torpedo, or you're performing a Roth conversion in order to avoid your RMDs being taxed at 32%, let's say, it may make sense to convert into this zone, take this added 3.74% expense. Sorry, I keep accidentally flipping to the next slide or the previous slides here. If basically you add in this added premium increase as a tax and it still makes sense, well then yes, you should be converting into these premium zones. Okay, so basically just take these added premiums and calculate these premiums out relative to that Roth conversion. Okay, does the effective tax rate on this Roth conversion still make sense when we add in these premium costs? If it does, well then still perform that Roth conversion. If it doesn't anymore, well then perform a Roth conversion so you avoid these Medicare zones. So instead of performing a $60,000 Roth conversion from a modified adjusted gross income of $50,000, we would only perform a $38,000 Roth conversion in this given example. Okay, so again, this is how you should assess if it makes sense to convert into these premium increase zones. Add these premium increases back into your tax rate. Add it back in as a tax. Does your tax rate still make sense in order to avoid those different tax hurdles down the road? A lot of times it still can make sense, especially if you have some significant tax hurdles down the road. So I know for a lot of people, just psychologically, it can people are fairly leery about performing a taxable event that pushes them into a Medicare premium increase because, again, a Medicare premium increase kind of feels like a penalty. But again, let's remain rational about it. Let's take out these our emotional feelings around it and just look at the numbers. Add back in those premium increases as a percentage of that effective tax rate. If the effective tax rate still makes sense on that Roth conversion, well then perform the Roth conversion. If not, don't perform the Roth conversion. Perform a smaller Roth conversion. Now, hopefully this video offered a little bit more insight into IRMAA increases, where these Medicare premium increase zones are, what the corresponding increase is, and if it makes sense to perform a Roth conversion, even if you're going to be subject to these different zones. Always remember, you don't need more money. You need a better plan. For those that like this video and are interested in more videos around these subjects, around Roth conversions and other parts of your retirement plan, again, make sure you hit the subscribe button below. If there are any questions, if there was any confusion with anything that we presented today, make sure you include your questions in the comments below. We'll try to answer those as soon as possible. Thanks for watching. Everyone have a fantastic rest of the day.